Easy. Well, good afternoon to everybody. Thanks for joining us. I hope you find this interesting. We founded the firm in 2006 as a chartered accounting firm that we thought we could modernize the industry by doing better things for our people, clients, and communities, and that's proven to be true. We always share the second slide, KPG, in 10 seconds for anyone who's busy. Revenue growth continues to be a strong feature of what we are good at Kelly Partners. Our EBITDA margin has compressed as we've taken on the largest chunk of growth in the last 6 months that we've ever taken on. Parent NPATA is up. Return on equity, I think, is very strong. Gearing is very moderate. Cash flow is very strong, and our cash conversion, I think, is excellent. But they're quite good statistics that we've published every 6 months for some time now, and is helpful, I think, and useful to anyone interested in understanding our business from a financial perspective. On slide 3, capital allocation inspired by the book The Outsiders by William Thorndike that we love a lot. These are what, from a capital allocation point of view, we strive to do: improve the earning power of our operating businesses, further increase the earnings through acquisitions, growing our existing accounting subsidiaries, organically growing our complementary businesses. And I'll just call out, we've got about 7.7% organic growth during the 6 months, with about 34% growth via acquisitions. Making programmatic acquisitions, so small but consistent groups choosing to join our group, and making occasional large acquisition greater than 5 million in revenue. We haven't done one for 4 or 5 years. Number 5, repurchasing our shares and certainly not increasing the number of shares on issues. So since IPO, we will have more than doubled our revenues while not raising any further external capital or issuing any shares. On page 5, our growth per share is strong, and I'll leave that for you to look at, but we're compounding strongly over time. We aim, like our friend Mr. Buffett, to be judged on 5-year periods, and the last 5 years has been, since IPO in June 17, excellent for the business. In terms of people, services, and clients, we've got a very high net promoter score from our employees. So employee net promoter score. We've got strongly growing revenues that are focused on accounting and tax. Audit, I'd call out, is less than 5% of our revenue, and our larger competitors have typically 25 to 45% revenue in audit that we think is less profitable, more risky, and more likely to be affected by technology changes in the future. And then we now have 17,000 client groups, assuming that there's a couple of husband and wife involved in those groups, about 35,000 people, which is a great community of private business owners, predominantly Sydney, Melbourne, and increasingly growing into Queensland. That's grown by 26%, and we think has tremendous potential to be quite awesome over time. On page 7, office numbers have grown from 19 to 28. There's an outline of the geographical spread of the group. On slide 8, we're just sharing that the cadence of our acquisitions continues to grow over the 5-year periods. Looking back, 6 in the first 5 years, 8 in the next 5 years, 27 in the last 5 years. We're confident we can increase the cadence of acquisitions as more and more firms are aware of us and choose to join our group. On page 9, and I think very significantly, is the business is not a new business, sort of popped together over 3 seconds pre-IPO. Business was founded in 2006. We've doubled the business 5 times in a row, on average every 3 and a bit years, and I expect that we'll have another double coming up imminently. And so we think that points to, this is not an accounting firm, but a group that has a business system for improving accounting firms and making them part of something that's better than they would be as individual standalone businesses. In terms of growth, revenue and EPS, it breaks down on page 10 as accounting grown by 5.6% organic, 2.1 complementary services, and acquisition 34.5, so for 42.2% growth. Annual compound growth rate since 2006 is 30.5%, and earnings continue to compound since IPO. On page 11, anyone that's interested in the business, we always publish a reading list. A book that we think is worth reading is The World is Flat, Brief History of the 21st Century by Thomas Friedman. And I'm basically making the observation to our partner shareholders that we can't continue to invest and deliver world-class people, client, and community impact we're known for and justify that investment if we don't do that on a global basis. It takes the same amount of capital to act locally as globally. Our clients over the next 25 years, and we're about building an enduringly great organization, are all going to have to earn a return on a global basis. And they'll need their accountants to help them operate in that new global world, and importantly, to think that way. We've always been a business that would rather show people than tell people. And so we are aiming and have upgraded our strategic intent for the next 5 years to become, on page 12, Australia's global accounting firm for private business owners. We make the observation that we're the 13th largest economy in the world, and yet larger economies have global accounting firms, but we don't. We're like a tributary state that takes the sort of dregs of the global accounting world brand and slaps them on an organization down here. We don't think that's been good for Australian businesses, and we're not sure that we can be better, but we're confident that we probably can't be worse over the next 25 years. And so on page 13, we've opened a group office in Malibu in California, pursuing, when we say growth into the United States, we mean California and specifically Los Angeles, to duplicate our partner owner driver model in that market. With between 15 and 20 sites that we've identified in Los Angeles where we think we can add value. And in the United Kingdom, out of London, we'll have a group office by the end of 30th of June, maybe sooner, to pursue our partner owner driver model in that market. That will give us Hong Kong in Asia, United Kingdom and United States, and we may well do something in Dubai. 5 global regions where Australian businesses either exist today or want to grow into tomorrow. And they, in my view, should have an Australian accounting firm that shares their aspiration to earn a return on their invested capital on a global basis. So that's first mindset, and then systems and processes and amazing professionals to make that happen. On page 14, our 5-year plan that was first published in 19 will achieve that revenue by 30th of June. Which will be a year early, which is terrific. And our underlying profitability is certainly at those levels. On page 15, our next 5 years, we've basically scoped out, in terms of strategy, objective, scope, and advantage. So top 10 in Australia while we scale complementary services and go global. In terms of scope, you'll see there our services and where an advantage. We think that our business system is a huge advantage. On page 16, our business system really, as a minimum, consists of a group business model or a group structure, centralized services team with a business model, partner owner driver way of structuring firms that we have trademarked and that is unique and that we've rolled out since inception on now more than 70 transactions and partnerships and or partnerships, and this central progress team that does very cool things for our businesses. The impact on an underlying business is that we can generally at least grow the profits by more than 50% of an underlying business and return at least 25% of partners' time to them, while taking away the things that they didn't become accountants to do, and therefore make their work and values experience of being involved in a chartered accounting firm much better. That's emphasised by a higher ENPS for our team and a virtually non-existent turnover of partners in our more than 75 partner partnership as it stands. Well, that's a quick overview. I hope some people saw our results in more details, and they're on our website and on the ASX website. And I thought today, got a little bit of time, Mark, I'm happy to take any questions if people want to pop them in the chat or ask them out loud.
Thanks, Brett. I might just get the ball rolling. Just on acquisitions, you say in your slides that you haven't done a larger one in the last couple of years. I'm just wondering why that is. Is it you know, pricing from the principles of those larger ones, you know, just are not realistic or not in line with, you know, what you wanted to pay, or, you know, a specific opportunities just haven't come across your desk? You know, why have the larger ones, you know, kind of eluded you over this last kind of, let's say, year or 2 years?
So Mark, the largest acquisition we've made was between 8 and 10 million of revenue. We said 8, the vendor said 10. We have no aspiration to buy large firms for the sake of it. So typically our industry has celebrated size above all things. We're a business that is a for-profit business and believes that our partners who sign joint and several guarantees and put their capital and good name and reputation at risk should earn an appropriate return. Many of the large firms are focused on being large rather than great, and certainly financially, you know, are average at best. So we're just not focused on that. In Australia, there's only 100 firms out of, say, 32,000 firms that are over 4.4 million in revenue. And so for us, with a programmatic acquisition mindset, we're really targeting firms that we think want to be part of what we're doing.
And then one from the audience
here. Certainly not pricing. Yeah, certainly not pricing. I can't say that we've really even engaged in, you know, a discussion with a large firm.
Okay. A couple from the audience. In the past, have you had any acquisitions that haven't gone to plan? And, you know, what was the kind of work then to kind of rectify the situation? I'm sure, despite the best due diligence, there's always one or two that, you know, go slightly awry. But yeah, maybe just comment on, you know, when that does happen, what's the kind of rectifying course of action that you would normally take?
Good question. So we've done more than 70 of them, so you can assume that, you know, to be able to keep doing them, but most of them have gone okay. For a deal to go to be more challenged, really, I saw a great book by a guy who's been writing a lot on the Stoics. The title of that book's "Ego is the Enemy." So if we get an egotistical vendor who doesn't believe that anything can be done better and that everything was always done perfectly in the past, then we will do everything we can to avoid bringing that type of person into the group. And in the past, where we've had some difficulties, and I'm just trying to think, there's been 2 out of 70 something that were just not as amazing as they could have been. And that was, you know, where you had, in one case, a vendor that wanted to go up the road and try and start again, which they weren't able to do. And another case, 2 other cases, really just egotistical vendors who want to sell you the business, take a check, and then tell you how everything was better before they sold the business. So, you know, we're pleased that we've been careful to not partner with people with those values. And of those 3, the third one being a person in a multi-partner firm that we partnered with, it didn't actually matter because they were one of a number of partners, and they were older and they wanted to retire. I'm not sure whether they're just cranky in their old age or whether it was us. So yeah, look, people are important, and whether they really want to join our group or just want to check is kind of the first filter.
Okay, great.
To rectify those, you just do a great job and the clients hang around, and time sort of heals most things.
Okay. Another question from the audience. What are you doing on price? Do you think you're priced too lowly in core accounting services? And do you increase churn when you raise prices?
No is the answer. We want to price competitively because it is difficult. You know, you can see our margins nearly twice that of the industry. So we know from a margin perspective, we're priced appropriately, and that makes it very difficult for competitors to compete. So we like that, but we are systematically raising prices, and that is growing our organic revenue growth. We're certainly not experiencing that we can't substantially raise our prices and not lose clients, which is great. So most of that 7.5% organic growth would have been price rise in the last 6 months. Okay. We know that because a lot of people have left the industry and a lot of older people are leaving the industry, there's going to be a lot less accountants. So we're quite confident that we're going to be able to raise prices quite considerably over time.
And then if we can talk about one of the smaller sections of the business currently, the investment office and the insurance broking operations, maybe what are the plans there and for expansion, and I guess how has it gone since you've launched it? I think maybe, is it back 2 years ago now the investment office started?
So the investment office, I think we did 4 years ago. First fund was 5.6 million. Second fund has now got about 30 million in it. We're confident that, you know, if that keeps doubling every 3 years, that'll turn out to be quite a good business. Insurance, we're doing quite a lot of life insurance. Our general insurance is a long-term, very slow growth style of business, and we're not confident that we've got that business doing all it can. But frankly, we see the complementary businesses as interesting, but relevant long-term, irrelevant short-term.
And then on the overseas expansion, in order to expand overseas, given the lack of scale, do you anticipate to operate with the same 9% services fees for UK, US firms, or will this differ from the norm?
No, we'll keep our services fees the same. I think it's worth mentioning that I grew the group from scratch with the same structure, and we had no scale at all. Started with 200,000 in revenues. So, you know, my perspective is that going into the US and UK, we've got absolutely gigantic scale compared to what I started with. So, so you know, I guess it's just your perspective. My perspective is, you know, there is no firm I'm aware of anywhere in the world that's got the structure that we have, and that is a growing source of competitive advantage in driving a flywheel of centralized services back to our offices. It just makes them better and better. So our run rate revenues over 93 million. With the deals that we expect to do this year, it'll be well in excess of 100. And at 9%, that's $9 million a year being invested under these firms. So if you take a like-for-like firm, a $5 million firm, there's two of them on the same street. You know, we partner with one, they've got $9 million a year being invested under them. And the $5 million firm next door doesn't have 9 cents invested under them, because most partnerships, when they make $1, there's, you know, 5 partners, 5 million, they make $1 million profit. They take $1,100,000 home. They overdraw. They certainly don't reinvest 9% into the business. So that structural difference is proving to be a huge source of competitive advantage over time, allowing us to invest in our team, our digital, and other interesting things that we think will very much accelerate the gap between our firms and other firms in local markets. Probably the worst thing that can happen to an accounting firm in Australia that's doing about under 10 million bucks is that we partner with one of their friends on the same street, because our firms will be just dramatically better resourced and therefore much more competitive over time. That's working very well. Now, overseas markets, well, I started with no money in services fees. We've started with a bit more than we did in Australia, so we'll do okay.
Still a few more questions coming in on the international expansion side, so let's keep going with those. Will the regions be run decentralized with their own management? But I think from what you've said in your last answer, that you know, it's a lot of it is still going to filter back to head office in terms of the shared services, at least anyway. So yeah, maybe just how you envision, you know, let's say you get to those 15 or 20 practices in and around LA. how is that going to be run from your perspective?
Yeah, so there'll be a services team in each market, funded by the 9% of that market, where we're building tools, particularly digital tools and software stacks to run over all of those markets. Obviously, there'll be a scale benefit. The major software stack that we've focused on building has only one part that changes in each of those markets, which is the tax lodgement part, but everything else will be consistent, in particular the proprietary software platform that we've been building. So we think that's okay. We've never used the term head office, and we never will. We have a services team that works under our businesses. They don't work for a head office, and there'll be that services team servicing those firms in each of their markets, paid for largely by each market. Great news is we've got thousands of pages of unique IP and systems and processes that are completely transportable across those markets, because those markets are very much more similar than different. They have exactly the same challenges and opportunities as Australia. The opportunity is just larger because the markets are just much, much, much larger. But the actual issues you're trying to solve are exactly the same issues. So it's particularly exciting. And the asymmetric return opportunity is huge. If we can buy a small firm, prove out our playbook, and start to just gently and quietly grow, we've built what I think will be in the top 15 largest firms in Australia within 12 months. And we've done that in 18 years. The market in California, for example, US, is 15 times the size of Australia. It's 12,500 target firms in California. There's 12,500 target firms in Australia. So it's, for very little capital investment, we think there's a very much asymmetric opportunity for return for our shareholders on the intellectual property systems and processes and business systems that we've built.
And then, just a question from me, in terms of, picking Los Angeles over another major region, whether that be Chicago or Atlanta or Boston, what was the overarching, I guess, attraction of, LA versus San Francisco or San Diego? Was it just, time difference, West Coast Australia West Coast US versus East Coast Australia, as opposed to, looking at one of the bigger cities on the East Coast or bigger states on the East Coast, like Florida, for example?
Yeah, very interesting question mark. There's a number of factors. First one is that if you want to be Australia's global accounting firm for private business owners, you need to be concerned with where Australian private business owners are playing. They are playing the largest expat communities of Australia are London and Los Angeles. Los Angeles is in the middle of London and Sydney, and sort of culture of LA is very much more open than the culture of the East Coast of America, and obviously much better located geographically. So that's the first thing. So Australian expats. Secondly, the geographical location. Thirdly, the size of the opportunity to grow. LA and California generally is the fourth largest economy in the world, with a very, very dynamic business environment that is very small and medium-sized business focused. So we have a US-based director, Lawrence Cunningham, who some of your listeners will be familiar with, and Lawrence is Deputy Chairman of Constellation Software, understands our programmatic acquisition mindset, and because of the thousands of firms in LA, we think that it's not overly ridiculous to suggest that we may be able to find some firms here that want to partner with us and have us work with them to improve their business. So similarly, our largest shareholders in London, he was very encouraging, both of them very encouraging of us looking at London, and we had a number of firms contact us out of Utah, out of London, out of Paris, out of the Nordic countries, to see whether we would be interested in partnering with them. So Australian expat, large dynamic opportunity. London's a global centre. LA's a global centre. We don't want to win the UK. We want to win London. We don't want to win the US, we want to win LA so that we have a focused market entry opportunity that we think is manageable. But the asymmetric opportunity is huge, because if we get it right and our playbook, is effective, then you're talking in LA terms 15 times the size of Australia. So it's quite possible that without taking any substantial risk, there might be significant opportunity for the group and our shareholders and all of our people. I guess the last thing I've mentioned, and really the most important, is that over the next 25 years, the real battle in our industry is a battle for talent, as it is in probably any industry. And we think that by creating a dynamic global opportunity for our talent, we'll attract better people, and they'll be able to move around and work within our organization in a way that they can't in any other. Because of our ability to work together, most global firms are sort of basically a hodgepodge of individual fiefdoms, which for talent means that they can't really move easily between offices. We aim to do the opposite of that.
And then a final question. Obviously, it's going to take a while to get up and running in each of these markets. What kind of investment from the main group is going to be required until these guys, get scale and get revenue coming in the door and, partners on board?
Well, it's a good question. I founded the business with my wife, Rebecca. We borrowed $160,000 and I had $200,000 worth of revenues. And I guess you can look at what we did with that. We feel that we're entering these markets with more going for us than we did before, than we certainly had in North Sydney when we started in 2006. And so I expect that we will invest less than $1 million in each of those markets over a 3 to 5 year period. And I expect that we can grow considerable businesses that are profitable and by size in those markets, and probably more effectively than we did in the first instance in Sydney, because we just we just didn't know then what we know now, and we didn't have the track record of financing connections and understanding that we do now. So I'm not putting to the market any great rah-rah or excitement about what the opportunity is, but we think that there is a group in Germany called ETL. They own 850 firms in Germany, 200 outside Germany. Private group, 1.3 billion euro in revenue. They've been running 50 years, running a similar model to ours. So we do understand the size of the prize in terms of what's actually possible if you can stay focused for a very long time and do an excellent job of your core business, staying in that circle of competence.
Right, we're just up on time, so I think we'll leave it there. And thanks very much for coming back in and giving us an update. And for anybody who's wondering about that book that Brett was talking about, Ryan Holiday is the name of the author, and I've read it myself. It's an excellent read if you're into Stoicism, and Ryan definitely puts out a lot of content. He's worth checking out if that's something you're into. And Brett, hopefully we'll be able to get an update from you later on in 2023.
Mark, thanks so much for having us. I remember the first Coffee Microcaps event I did, and it introduced us to a number of quality shareholders who've been with us a long time now. And I really appreciate your interest in the group, and we'll get back to work and keep making things happen quietly.